Good evening, everyone. Thank you for joining us this evening, or if you're watching this at a later time as a recording. My name is Robert Cruz, one of the principals at the Lutz and Cruz Group, powered by Place, here at Keller Williams in Cupertino. And this evening, and if you're again logging in to listen to this as a recording, we're going to talk about the Silicon Valley real estate market. We're probably going to talk in a way or a manner you may have never heard before. We are going to talk about some of the fundamental numbers and forces that affect our markets, that affect the prices and strategies we use around navigating a very, very difficult real estate market. As I said, we'll focus on some ideas and thoughts you may not have heard before. This is not designed to be a comprehensive or explain every single thing that we talk about, but more to show you kind of our methodology, kind of how we approach our market, so that when you as a buyer or seller have questions about the sale of your property or purchasing another property, questions around price, questions around timing, questions about the market and what it's doing locally and overall, you'll have a good idea of where our answers come from, what drives the answers, how we explain what we're doing, and hopefully give you just some really cool insights into what we're doing. As a way of background, I've been a broker here in Silicon Valley since 2002. So I saw that first initial bubble rise up from 02 to 06. I saw it crash. I saw the aftermath. And since 2012, I've seen this market recover and grow and grow and grow and grow and grow, almost unabated until around April or May of last year and all the way through the end of the year. And I believe in recency bias. I believe we put far more emphasis on what we've recently experienced or heard or talked about versus longer term trends. In our markets, that can be a really bad mistake. And especially, as I mentioned, since 2012, Silicon Valley real estate has been on an incredible pace. If you're lucky enough to have owned property or owned it during that time, you made incredible gains in your equity. If you've been trying to buy in this period and so far have been unsuccessful, I know how frustrated that can be. I know how going in, making bids, losing to multiple bids, seeing prices go hundreds of thousands of dollars over asking price is intimidating. It's scary, and it feels like it's never going to be the right time for me. We've also seen the last, especially third and fourth quarter last year, a lot of news and negativity come out and say, finally this bubble's bursting. Prices are going to fall, real estate's going to crash. And we heard that narrative for many, many months last third and fourth quarter. And there was some validity to it. It wasn't just completely misplaced information. Our markets did stall. Our number of transactions dropped by 30, 40, 50% in some places. And I don't care what industry you're in or what service or good you're selling, when sales drop by that much, there is a problem. There's no way around that. But identifying what that problem was and how it mattered or affected your own personal decisions around buying or selling real estate, when you understood that, there was incredible opportunities, both for buyers and sellers. And that continues even today, as we've seen a massive rebound in buyer interest. We're once again seeing properties last days, not weeks on the market. We're seeing multiple offers. We're seeing open houses, even with all the rain we've been experiencing, 30, 40, 50, 100 people into these open houses, a lot of offers. And again, really quickly, buyers especially have felt, I thought this was my time. I thought finally prices would fall. Finally, I could make an offer, a reasonable offer. And so don't feel despaired. Don't feel frustrated or worried. Let's look at what's been going on, what drove that, and what you need to understand and look at in the coming days, weeks, and months if you're thinking of buying or selling. So we're going to start, and we're going to explain really quickly three really important factors, two that you're all probably aware of: demand, supply, and demand, right? Again, in any economic structure, when those two things are imbalanced or when they reach a balance, prices are affected. If demand is high, supply is low, prices go up. That's been Silicon Valley real estate overall since 2012. Chronic low inventory environments and lots of buyers in that constrained market And that's why we've seen consistently prices rise over time. The last 3 years, 2021, 22, that's been even more pronounced. Lowest levels of inventory ever, and a lot of buyers in the market all at the same time. That created runaway prices in an environment in the economy overall where inflation was rising. And this time last year, the Federal Reserve started telling us, hey, we've got to do something about this. And what we're going to do is we're going to make money a lot more expensive. You can still buy, it's just going to cost you more. The interest rates that we were used to in 20 and 21 that were in the 3 to 4% range, all of a sudden within about a 50 to 60 day window spiked to almost 7%. In fact, we reached 7% for a short time. And that created a shock in the market. All of a sudden, the buyers that were gobbling everything up weren't there. And the sellers who got used to 2, 3, 4, 5 offers for any property at any price were now receiving none. Or if they were receiving them, it's certainly not what they were hoped for, and maybe not even what they were asking for. And so then the sellers were in a position of, is this short term? Is this long term? Is this the offer I have to accept? Or shall I wait? Long story short, a lot of them said, I'll wait. And they took their properties off the market. And so what we saw, even though rates did not come back down to 3 or 4%, they did settle down into the 5 and 6 range. But once buyers realized these prices aren't going to change, these interest rates are not going to fall any further, and we still need a house, then they had to make offers. We entered this year with a lot of those sellers that refused to put their product on the market when demand was so much lower, created an environment of, again, super low inventory, driving prices up. And that's where we are today. The last factor is that I love to teach is speed of the market. And that's the idea of how fast do properties last on the market. That's not as commonly understood or studied or talked about in our business, but I found in the 20 years I've been training agents and teaching and talking to buyers and sellers, that is the most important in many ways factor in our local markets. And I'll explain it in a second. What we see here is a graph showing two things. On the bottom axis, month supply. How many months would it take to sell the number of properties that we have on the market in a given time period? You see from 10 months on the right all the way to 1 month or less on the left. On the left axis, you see percent difference between list price and sold price. And when you shorten the month supply down to 1 or 2, you see that you increase the percentage list to sales price. And you see San Jose leading the way up there, right? We chronically have less than 2 or 3 months supply in our markets. And while prices rise, interest rates rise, while that constraint is there, it makes it difficult for buyers to negotiate prices down because the properties are so scarce and they still move so fast. So I'll show you in a second, we've consistently been in that less than 2 months of supply for almost a decade now. And that's why you see our list to sales price ratio is consistently over 100%. And we're right back in it today. We'll show you where we are in a second. But keep this idea in mind, speed of the market, how fast is it moving? When you see a house, you like a house, how fast do you have to act? And then how many other people are like you, looking at it, liking it, and moving quickly? Offers come in 1 or 2 days after a house is on the market. If there's multiple people, that puts a real pressure on, you've got to bid high, you've got to bid fast, and we see what happens with prices when that happens. So when these two things continue, low supply, you almost always see this push up on prices. I always like to put people in a frame of mind, understanding that this lack of supply, this low number of available listings is new, relatively speaking, over a 25, 30-year period. But for the last decade or so, it's actually the norm. Since we left that terrible period in real estate here locally in 07 and 08, and into 10, 11, when we're still kind of flooded with REOs and short sale, which reminder are forced sales. That wasn't people deciding they wanted to sell. That was a bank telling them you have to sell. And that's why you see such a massive spike. Even in those periods, you had people that had to sell. They were retiring, they were moving up, they were moving down. But a large percentage of those were forced sales, people that had to sell their homes. And because they were being foreclosed on, they weren't the typical, I'm going to sell a house and then buy a house. So at the very same time, we had an exaggerated number of listings and a depressed pool of buyers. Ultimately, what that resulted in was low inventory that you see here, and has remained at that level for a long time. And we slowly started to rehab and build back our buyer pool. And for the last 3 or 4 years, we've been in that perfect storm, really low inventory, buyers back and forth. When you shorten the time periods, the top line is that list to sales price ratio. You can see over time, you dramatically reduce the number of properties on the market or time on market, prices get pushed up. We shrink that time period to like last 15 months or so. And if you've been paying attention to the market, again, that last part of 2021, that first part of 2022, very low inventory, ton of demand, interest rates were still in the 3s and 4%. And you can see days on market was certainly below 2 months. It was less than 30 days. In many cases, it was in almost single digits. And you see the resulting buyers that were making offers on these properties at this speed were having to pay 9, 10, 11, 12, 15% over asking price. This wasn't way ancient history. This was only 12 months ago or so. And then again, you can see clearly when interest rates rose from 3 and 4% up to the 5 and 6 and ultimately 7, buyers still purchased. They still purchased the houses, but because you decrease demand, because some buyers left the market at those prices, and you increase the time on market, as you can see here, start to rise steadily, the kind of offers that were made started to change dramatically. It dipped as low as 97%. This is countywide for single family residences here in Santa Clara County. There's still a healthy market, getting 99, 98, 97% of what the seller wants. Mind you, on average, that means some got a lot lower and some got a lot higher. But following the general market trend, we understood we were in a depressed market for this 3rd and 4th quarter. Early or late last year, we started to look at these numbers and started to see some important changes. It's clear to see that there was fewer buyers actually making offers. But what we like to look at is who is qualifying themselves for a mortgage, taking that first initial step. Because we know that when people go and apply for a mortgage, that means they're going to be writing offers and getting into contract in the next 30 to 90 days. So what you don't see here is as supply was rising, interest rates were rising, and demand was falling, the number of people applying for mortgages plummeted. We dropped by 30, 40% in most of the months at the end of last year. Even today, we're still around 35% fewer in February and March of 2023 as we were. So in that global view, a lot less demand. But hidden in that is since about November 9th, we started to steadily rise week over week in the number of people applying for mortgages. So we looked at in November and said, this is recovering, bringing buyers back into the pool, and the listings are not there. The inventory is not there. So we were confident that that was going to put pressure on prices upward in the period we are right now. And true enough, it happened. Again, we're not saying we can read or we don't have a crystal ball or anything, but we can read the data, and we do. And that's a service we provide to all our clients, whether you're a buyer or a seller. You look at this leading edge data. We certainly understand what's happened before. We can interpret and help you understand those conditions, past trends, past conditions. But truly, when you're talking to us, what you want to know is what's going to happen next. And that's what we really try to focus on. We can judge what's going to happen next because we have such a mastery, not only of what happened in the past, but why it happened in the past. We don't just measure it and say that's what it was. We look at what were interest rates like? What was the global economy like? What was the national economy like? Was unemployment up or down? All of those things affect mortgage rates. All of those things affect consumer confidence and ultimately affect prices. And so that leads us to the next part, demand. As I just kind of mentioned, we took a massive hit. You can see here on the far right, this is going back all the way to 1990. You can see that bubble that we were in from 02, 05, all the way into 06. Tons of people buying houses. No shortage of people wanting to apply for a mortgage and buy a home. We saw the crash. And we saw that crash on demand just collapse. And then again, in the last almost decade, rising steadily. That's what I meant when we recovered demand. We rebuilt that demand of available buyers and sellers. Late last year, this is the collapse we're talking about. Rates hit 7%, buyers disappeared overnight. Not all of them, but again, about 35, 40% of them. Way over on the far right, you can see that bump on the right. That's that week over week, slowly rebuilding that buyer pool that disappeared in that May to September, October time period. The crash or drop was faster, the rise was slower, but it's the same principle. Buyers went away here, and then we slowly rebuilt the buyer pool. We're seeing it in real time in a very compressed period in the last 2-3 months since November. So here we are now, March. Think of the buying season, start of the buying season, and what we were predicting has come true. If you're out there looking at properties, writing offers, you're once again shocked that you're competing with a lot of people for a very small number of properties. We were told bidding wars are gone, go look for bargains, real estate's going to be on sale, and it's the exact opposite. We're back to 21, 22, where you're having to compete with a lot of people. You're having to go in aggressively over asking price. You have to go in aggressively on conditions. And so again, buyers immediately, it's got like PTSD. It's like, here we go again. I finally thought it was my time, right? It might be your time. There's a couple important differences between what we're experiencing right now and what we experienced in the 2021 explosion and the 2022 explosion. And we'll go into that in a bit, but it's very important if you're in the market. On the supply side, as we said, over the last decade plus, consistently lower and lower inventory. This is nationwide, but we're no different here in Bay Area. So what we're experiencing and fewer people putting their homes on the market is systemic. It's nationwide, it's region-wide, and it's certainly true here in Silicon Valley. It affects us more because our prices are already so high. We're already one of the priciest areas in the country. And what that creates is, as new buyers come into the market, they're already entering into an elevated market. And now, in this time period, they're seeing another bump in the short term. So very evident. And again, you can see here the long term, the bars are properties for sale. And you see number of new listings also maintaining that really, really low number. I show this to tell you a lot of buyers are waiting for those prices to fall. The one thing that's going to have prices fall here in Silicon Valley is if we get that big number of listings again, if we blow up the supply. And there's nothing in our current conditions that show us that that's coming, right? We left it behind a long time ago, and we don't see and we don't foresee any big major push of new listings on the market. So the overall trend for over a decade is lower inventory over time, and each year less than the year before. That supports prices. So that's the good news, believe it or not, if you're a buyer. It's not good news waiting for the collapse in prices because we just don't see it happening. And that means when you say, I'll wait till next year when the prices fall, well, the prices went up. And then I'll wait for the next year for prices to fall and the prices went up. And so you eventually price yourself out of the market. Versus if you look at these numbers and you see these long-term trends, the sooner you buy into the market, then you become the homeowner, and then you become the person building that equity, right? And that's a tough pill to swallow. I understand that. right? But that's why we love to get in front of you and kind of share with you these numbers. We don't want to sound like salespeople saying, well, prices always go up. Obviously, that's not true, right? But is your timeline the next year, 2 years, 3 years? If it's that timeline, we can show you the data that says prices are supported. If you can wait 5 or 6 years, we will get a correction at some point. Now we're overdue. We typically get price correction in Silicon Valley every 7 or 8 years. We haven't had one since 2012. We're on year 11 without a price correction, right? Now, when I say that, some people are like, aha, you see, we're overdue. We're overdue, I get it, but what's showing me or what's showing you that we'll expect price to fall next year? Nothing. Again, doing this for 20 years, I have been hearing since 2012, next year's the year. Next year's the year. Eventually they'll be right? Maybe in 2030 or 2028, I don't know. Eventually the person that says every year, next year's the year the prices fall, they will be right. But does that serve you as a buyer? No, right? Because you don't own the asset. You're not growing your equity. You're not getting into that class of investor, even if it's your own home, that is invested in a rocket ship of investment product, which is Silicon Valley real estate. Now, I don't have a ton of time, but one-on-one, we would explain more deeply why we feel so strongly that these prices are supported. And when you buy now, you save money because you make money over time owning it. The challenge is actually getting it. I get that, right? And so let's dig in right now into our current numbers. Start to get into the idea. If you're in the market to buy right now, and you speak to me or one of my partners, we're probably going to have an aggressive strategy, right? Buyers don't want to hear that. I get that. They have fatigue. And it's incumbent that we explain, why do we have such an aggressive strategy? It doesn't mean you have to adhere to it, but you should know, right? We like to say, if you write offers, write them to win. If you're not ready to write to win, that must mean you have another objective. Let's get to that objective. And for some people, it's like, I'm not willing to write what it takes to win, but I do want to own a home, but I want a value. I want value in it. There are ways to do that, and I'm going to show you that in a second. So overall, very simple. If we ever one-on-one with you, we'll go more into detail, but I want to show you 2 simple things, and you can look it up on your own if you want. The 2 lines that I watch, that blue line, are new listings, fresh inventory into the market every single month. The red line is pendings. That means a buyer liked it, made an offer, and it's off the market. They haven't closed it, they don't own it yet, but it's off the market. When those 2 lines trend together, the pressure on prices goes up. And that's because the Silicon Valley real estate buyer prefers the brand new, freshly listed, perfect turnkey house. And so they snatch them off the market quickly. And so that pending and new listing number, they stay tight. You can see the reason doesn't matter. But when you see that the 2 lines detach from each other, especially when the red is below new listings, that means the buyers are pulling back. That means the pressure on prices is relieved. Mind you, it doesn't necessarily mean they lose value. It just means instead of paying 15% over asking price, you may only have to pay 1% over asking price, right? And you can see here, it's easy to see why it happened. Rates went up, buyer demand went down, and the sellers just weren't receiving as much as they hoped for if they closed. But mind you, there was still a nice red line. People were still buying, but the sellers weren't happy with what they were getting. So they took their homes off the market. They took their homes off the market. Interest rates dropped from 7 to low 6s, and the buyers came back in, and you see the lines come together again. And again, here you see, not only are they coming together in February, but you can see the trajectory. The red's moving much faster and likely past the blue. We're back in competitive bidding wars, going over asking price. Right? Another thing that we look at and we'll share with you is forward-looking numbers. Right? Again, we can explain to you what has happened in the past, but you want to know what's next. You're looking to buy or sell a house in the next 30, 60, 90 days. Your question is, what's going to happen next? So we measure absorption rate as a very important number in our markets. Because we move so fast, we're not moving in 90, 120, 6-month cycles, we're moving in 30-day cycles or less. And so absorption rate measures how fast do buyers take off the properties that are on the market, regardless of how many, right? So that means in a day with 30 months, if we have 30 listings, if we sell all of them that month, it's 100% absorption rate. That's a good seller's market. If we sell all of them by day 15, we're in a 200% absorption rate. If we only sell half of them by the end of the month, we're in 50%, right? Anything above 33% is considered a seller's market. Once again, looking at recent history, when prices were exploding, you could see in Santa Clara County, we were far above 33%. We were in high triple digits, 292, 160, 215. And when we saw the dip, we never left a seller's market. That doesn't mean some sellers didn't panic and sell for less than they should have, in my opinion. But just structurally speaking, looking at the data, we never entered into a buyer's market. And I know for myself, or even speaking at the time, we were telling people it's a seller's market, it's a seller's market. Everything else was telling them no, right? But we looked at our numbers, our data, and we were able to give them really, really good advice. When we saw the numbers pick up in number of people applying for mortgages in November, we knew this would pop in the future, and here we are. Here's that spike in February up to 114%. And this number is why we're seeing multiple offers over asking price in our market. Very few properties for sale, buyer interest back in full force. That's going to result in prices going up, right? So even though we've not yet seen a massive drop in days on market, there's overhang there. We have seen, you can see here, in December, buyers are paying on average 94% of what the sellers were asking for in the county. In just a 30-day change, that jumped to 99. Now, mind you, we're talking about prices that are up above 1.5 million, around 1.7 median price. So on a median price of 1.7 million, a 5% jump, it's almost $75,000. And once again, these are averages. So some homes are going for more than that, and some are going for less. Remember I said earlier, if you're a buyer, don't get frustrated. There is value, right? So if you're like, Robert, I understand these are expensive, but I want a turnkey house. I want in the nicest street in the best neighborhood, and I can afford those prices. This is your market. If you can't or you won't compete at that level, then understanding that these are averages, you should be asking us, find me the ones that are at 92%, 94%. Which are those? So I've told you, the Silicon Valley consumer real estate overwhelmingly likes a turnkey property, the one that's ready to go. It's already painted, it's already fixed. The kitchen is brand new, perfect, everything. But that wasn't always that way. A lot of those sellers said, I'm going to list it in 3 or 4 months. Let me upgrade my house, so get top dollar. Imagine you find that house before it's upgraded. Because if they put $30,000 or $40,000 into it, there's a premium paid when they sell it to you, and they mark it up by $100,000. And if it's in a right environment like this, then it's bid up another $20,000 or $30,000, right? Versus going and finding that value, find the house before they painted their preferred color, before they put in their preferred kitchen, before they put in their preferred bathroom. You do it. The average that makes up 99, you can find the 93, 92% of asking price. I'm not telling you it's the prettiest house. But when you understand these conditions, then we can have that conversation. I can get you the perfect house. This is the price. Because that's what most of the competition is. If for whatever reason, budget or just you're morally opposed to paying that kind of a premium, then let's find you that house. I'm not talking one that's not livable. I'm not talking about something that's a wreck that you can't move into, something that you can move into. And slightly above cosmetic, great value in there. As I've said, values overall will continue to rise. If you follow that rising trend line and you buy below whatever that current trend line is, as soon as you fix that property up to the standards that the buyers in the current market want, you get a massive jump in your equity and the value of the property that you live in. And you get to pick your favorite color, right? How can you beat that? So again, this is fast. This is a ton of information and not designed to completely show you what all this means. It is designed to show you when you sit with us and you ask us about the market, when you see a house that you like and you want to write an offer, or when you're thinking of selling and you invite us into your home to do an analysis of what we think it will go for, what it'll sell for. We do what everybody else does, right? We know what the schools are like. We know what colors buyers are buying. We know how to stage and photograph and market your home, but so do all the good agents, right? What stands out? What's the difference? I'm positive no one can go to this level and explain to you, these are current conditions above and beyond what we do as regular realtors. This is what we do as advisors to really help you understand market conditions, help you time the sell or purchase of your property. Many of you have something to sell before you buy. And that creates even more opportunities to find value. And we can explain that at length for you if you are interested. But understanding these current conditions, taking 20, 30 minutes on a one-on-one Zoom call or in person. And while this is all of the county, if you've got a condo to sell in Alum Rock, we'll tailor this information just for that particular type of property in that neighborhood. And when are you thinking of selling? If you're moving up and buying something in Sunnyvale, you have a $2.5 million budget, then we won't care about Alum Rock. We'll focus all the data on what's going on in that neighborhood, in that area at that price point. And we'll give you information and analysis to help you make a really, really wise decision. And even that, even when you pay top dollar, if you do it with this kind of analysis in a rapidly improving market, even that's a value. Because you get into and start building your own equity as soon as possible with a real clear understanding of what did you just buy, right? The neighborhood you purchased in, the type of home, the way it looks, that's easy to understand. But as an investment, and even again, even when it's your own home, it is an investment. It will go up in value over time. When you sell it, you will make money. I know that because the government will tax you, right? So every time the government taxes you, that means you made money. We'll help you with all of that. I want to finish by just doing a quick little explanation of what's an example of what our market's doing. And so what I have here, every Monday morning, I wake up and I record every neighborhood in our county, and I measure number of active properties and number of pending properties. Are they up or are they down? And I compare it. This example is the second Monday in March of this year. I'm comparing it to the second Monday of March last year. So when you see Sunnyvale and you see that listings there are 27% lower than they were the same time last year, that's showing you real scarcity. It was low last year. It was low last year. And that's why last year at this time, with 27% more properties, Sunnyvale homes were getting $200,000, $300,000 over asking price. The prices are higher this year. The interest rates are higher this year, but the available inventory is far lower. And that will trump the higher price and the higher interest rate. We won't grow at the rate that we did last year, but we will grow in price. And that's important because everything else being equal, when a buyer buys in Silicon Valley, the first place they look for, Sunnyvale, Cupertino, Santa Clara corridor. All the things that homeowners consider, neighborhoods, availability of shopping, entertainment, access to freeways and commutes, access to job centers, that's the heart of it. So that's where people start, right? So when we're starting in our core market, 27, 29, 3% fewer listings, if you're paying attention, that's when you hear the stories of 50 people, 100 people at an open house, 20 offers in, $200,000, $300,000 over asking price. Not last year's headlines, last weekend's headlines. And it'll continue this weekend. Now you think, well, I'm not buying in Sunnyvale. Thank God. Well, be careful. Because when those 50 people make an offer on one property in Sunnyvale, only one wins. Only one wins. What happens to the other 49? Well, some go to the next property in Sunnyvale and they write a higher offer and they win next week. But at some point, some of those people are priced out of that price range, right? If I'm looking in Sunnyvale and I get priced out, I still want a good neighborhood. I still want good schools. I'm going to go to Fremont. I'm going to go to Evergreen. I'm going to go to Blossom Valley. And then I become an excess buyer in limited demand in those areas. So 2, 3, 4 weeks after these prices blow up, it trickles down through the rest of the valley. So those are the kind of tips and tricks we can share you, right? If you come to me and say, we want to buy a home in the next 3 or 4 weeks, we're looking at Alum Rock, we're looking at Willow Glen, we're looking at Blossom Valley. The first thing I'll tell you is, do you know what's going on in Sunnyvale? We're not crazy. We know when your timeline is 3 or 4 weeks, so is a lot of other buyers that started in Sunnyvale. And you don't want to compete with that buyer. Think about it. They just got beat by $100,000 on a $2 million house. And now they're like, let me go look at a $1.6 million. They're fresh off losing by 100K. What kind of offer do you think they'll write on that property? And you come in your first week and saying, well, I read the news, prices are down. It's listed for 1.6, let's offer 1.5, right? This is from experience. And I'm very, very aware of budgets. I'm not trying to minimize the difficulty and the cost of buying in Silicon Valley. But I do want you to understand, if you have the capacity, if you have the willingness, and you understand how these pricing factors work, buy it this week versus 2 weeks from now, because it's going to go up 50, 60K, right? When you click on this, we'll share with you in whatever market you're in. We track forward-looking absorption rates. Remember I said that measures how fast buyers take properties off the market in a given month. When that absorption rate starts to drop, meaning demand is declining, that always results in a 2 or 3 month lag of the list to sales price ratio falling. The opposite is true. When you see a massive jump in the absorption rate, meaning buyer demand is aggressively growing in a small period of time in a given location, list to sales price ratio jumps also. So what we'll see over the next 3 or 4 weeks is the buyer demand in Sunnyvale, Santa Clara, Cupertino growing in a very small pool of homes. We'll see the prices jump 105, 108% over asking price. That will create a wave of buyers moving into lower priced neighborhoods. So it doesn't matter which neighborhood you're talking about as a buyer or seller. That also doesn't mean you're going to have to act. What we would like to know is you've been really educated on what is going on real time in our markets, in the areas you're thinking of buying or selling. Sit with us for 15, 20 minutes. We'll tailor a presentation like this just for what your wants and needs are. We'll give you the best advice we can. It's only advice. And then you and your family sit and think, what's best for us, right? But we really want you to have that full picture of what is really happening now, so you make the best possible decision. And then we'd be honored to sit and talk with you. We'd be honored to sit and talk and explain. And if it's the right time for you, we'd love to help you. If it's not, maybe we put a strategy for the next 6 months or a year and see if that's the best time for you. Either way, it will cost you your time, 20, 30 minutes. Reach out to the person that invited you. They can certainly help you, but I'm willing and able at a moment's notice to sit down with you and them and go into as much detail as you need, answer any questions that you have. Let me put my 20 years of experience in this valley, training at this depth and this level of understanding of our market conditions to help you make a great decision. So I don't see any questions or hand raised. If there are, it's a great time to ask a question. If you're shy, you can type it in. This is being recorded. I'll go back and look at it and we can answer it later. Or best of all, reach out to the person that invited you. Schedule a 20, 30-minute Zoom or in person and we'll do this one-on-one with you and your family and help you. All right. So thank you for your time. We do this every Thursday. If you can't get enough of this, come back. I'm only half kidding because the markets do change that fast. They do change week to week. As I explained how they cascade prices down from Sunnyvale down through the rest of the valley. Your wants and need changes, interest rates change. So come back next week, or again, better yet, schedule some time with us. All right. So thank you for joining us. If you're getting this later as recording, thank you for watching it, and hope to hear from you soon.